And you have put together some great stats around what we're seeing. Walk us through a little bit. So non-farm payrolls, the U.S. jobs report. What are some of the numbers we've seen? What are some of the context behind it? 7:30, the main takeaways from this event are, again, non-farm payrolls. And these are the amount of jobs either added or taken out of the economy on a monthly basis. Now, why is it non-farm? Why don't they just say everybody?
So it excludes agricultural jobs, mainly because they're more seasonal roles. So that's why. I always wondered that too. And it's considered pretty significant. You'll hear me talk about this a little more later, but because it makes up about 80% of GDP. So that's why people tend to really pay attention and view it as an economic indicator.
Okay, so yeah, employment, obviously an indicator of health. We'll get the non-farm payrolls. So in other words, jobs added or lost, the unemployment rate itself, and then something called hourly earnings, which is a gauge of inflation. If people are making more, we tend to see a little bit more inflation. So each of those three numbers will be parsed. There's an expectation and whether or not it meets the expectation. So walk us through a little bit what you've put together here.
Yeah, so I kind of came up with a review here of what we've seen in the past, what we've seen in October and November in the past 5 years, and kind of those averages, and the implications on the Forex, potential implications on the Forex market. Because at first I was like, well, it's just in the U.S., but it does affect, or it can affect how the dollar is viewed compared to other currencies. So to give a review of this year, there is a forecast of 200,000 jobs being added as of today. And this is a big comeback from last month being a very measly 12,000 jobs added. And granted, this is a bit of an outlier due to external factors. So the strikes at Boeing and the hurricanes are two big reasons that this is considered to have been so low. However, they couldn't directly prove it, but it's pretty much insinuated. In the past several months, it's been kind of a softer year, which you'll see in the next slide. Our biggest month was September at 223,000, and obviously our lowest month was October. But generally, we were floating in the mid 100s to low 200s range. So
absolutely, and the key thing here is the market will react off of what the expectation is versus what it actually is. So this is great context because you've gone second level here to think about how it affects and how it moves, which is great, and variance. The idea of trying to guess, well, I think that number is wrong, just let the number come out, let the market react, and then you decide what you want to do. But please.
So yeah, and then I'll talk about past years because I think in addition to looking at years as a whole, I think certain times of the year is also relevant because obviously different data reports come out at different times of the year and political climate and that whole thing. So I went over October and November over the last 5 years. And then I have a question for you, Pete. So if you look at 2020 and 2021, you'll see that in October, for 2020, and then in October and November for 2021, we're seeing over 600,000 jobs added, which is pretty crazy. And a lot of this has to do with the pandemic and a little bit of relief from that. But we're seeing an overall average in these months over the last 5 years of around 364 and 329 jobs added respectively. Now, granted, I would consider those 600,000 plus values to be a bit of an outlier here. But even if you were to take that away, we would still be experiencing a softer non-farm payrolls year than these previous years at this point in time. So do you think that that's pretty standard? Do you think we're just aiming, to keep inflation around a certain number and unemployment around a certain number, and that's all that matters here? What do you make of all this? Yeah,
I think you're spot on. Is that looking back, this is tough because we're coming out of pandemic and seeing again so much of the dramatic job cuts come back in and that growth. I think what we're seeing is with the hiking in rates from 0 up to almost 5% in short-term rates, the idea was to slow inflation in a hot job market. In other words, if you have a lot of jobs being created, that tends to create wage inflation also. If there is a lot of job growth, people are seeking to hire a lot of people, that tends to put pressure on wages.
Yeah.
So what the Fed would ideally like to see is job growth moderate, so it's not so prone to creating wage inflation. So what we're seeing is as rates have come off, that has come off with a little bit of the effect of higher interest rates slowing down the jobs market a little bit. So from the Fed's point of view, it's kind of working out really nicely right now.
Yeah.
We haven't imploded. Job growth hasn't fallen to zero. It's moderated. Wage growth has moderated. Inflation's down. This 180 to 200 is probably a sweet spot for them.
Yeah.
And the 4.3% of the workforce, there's always, that's considered really what they call frictionless unemployment. There will always be part of the workforce unemployed. It's just people switching jobs.
Right.
You never get down to zero. Okay, everybody's got a job.
Yeah.
So they tried to guess. It used to actually be closer to 5% was that frictionless unemployment rate, where basically everybody who wants a job has a job, and it's that 5%. They've now taken that down to a smaller number around where's that level where it is a robust job market without being too you've heard the term overheated job market. That's
right.
Where there are more people looking, there are more firms looking to hire than there are people available to be hired. So we're at the spot right now where we're looking at this level. I think this is great context because you can see here where we went through a heightening cycle in 23 and 24, and we saw non-farm month-to-month job growth slow. This is what you would expect to see.
And even if you look at just the last 2 years, like taking COVID out of the picture, or 2019 and 2019, you kind of see, okay, we're, save for October with, the natural disasters and the strikes, we're kind of floating around a similar, trend here. So
Absolutely.
And then I wanted to talk about potential implications here, because even when I started learning about non-farm payrolls a while ago, I was kind of confused about why in the Forex market we emphasize them so. I'll let you guys know now. I gave 4 big reasons here, but there are plenty. Number one is it can be viewed as an indicator of economic health. So because it covers a high amount of the workforce, it can suggest good economic activity and lead to increased market confidence. Also, its influence on unemployment rate, I would say this is one of the biggest parts because it's pretty highly correlated to the unemployment rate, and high numbers in non-farm payrolls correspond to a decreasing unemployment rate, typically. And there's also interest rate expectations. So we've got that meeting coming up on December 18th. And non-farm payroll data tends to influence the Fed's monetary policy decisions, and one of the 2 mandates for the Fed to balance along with inflation, unemployment.
Right.
So strong job growth can lead to increased interest rates, which are used to control inflation, and they can affect the market dynamics as higher interest rates can lead to a stronger dollar. Again, this is amid many other factors. We obviously don't know exactly how things are going to play out, but this is just the economic theory behind it all. And then there are more broad economic implications. So non-farm payrolls data can also affect equities and commodities. So positive job growth can boost stock prices, and negative reports can lead to sell-offs. Again, it all just depends on, the context and what else is going on. But this is just generally in global economics, like what's considered when it comes to NFP data. So,
and that is a great broad overview from as an FX trader, as a new FX trader. Out of those, what do you think is the one that will most directly impact FX rates?
I think
in the short run.
In the short run, that's really interesting. I mean, I might totally be wrong, but I think of equities. I think of equities and commodities, and I think of but I also think about unemployment. and interest. Oh gosh. Okay, so that was all of them. I mean, like with the December meeting coming up, I'm gonna have to go with the third one because of interest rate expectations. Because
Good job on it.
you know people are gonna be buzzing about that after that's released. I'm sure.
You're absolutely right. Interest rates drive FX markets. Tick for tick, no, there's no perfect correlation. But interest rates and interest rate trajectory, which is how fast are they going to move in interest rates. Again, that will drive momentum in FX markets and the relative value. Again, if you're trading a pair Euro USD, and it seems like US dollar rates, interest rates, are going to rise and rise more precipitously, Euro rates are relatively stagnant and may be cut. That's going to tell you if we get numbers that say US interest rates may rise, we're going to see the euro fall in relationship to the US dollar. So that interest rate piece is probably how that plays out. And we'll see that play through the bond markets in the US instantaneously. The minute this comes out at 7:30, we'll see the bond markets have a reaction to this. And from that, you'll see a reaction into the equity markets, into commodity markets to a lesser extent, but definitely into FX markets. So you're spot on. Great walkthrough about a little bit of the context around why this is. Now, I will put the trader context around this. Nonfarm payrolls is a backwards looking number. So it is a survey from employment trends 30 days ago. So how much value do we put into it? We look at it and we put context into it. We also know that it's revised every month. So last month's will be that very low number from the strikes will be revised. So it could be very different. You would think, oh, we react so dramatically to it, and now it's not. So the main takeaway here is understand a little bit of the constituents. It gives you a little bit of insight into inflation, into job growth, and the state of the job market. Those are all good macro indicators. What I want is to see how the market moves off of it. So let's jump back to the platform, and let's talk about a little bit of some of the markets we've been looking at. And think about, and let's go to Euro. What's our game plan for that? And we're going to go out a little bit further and just, we could use an hour. That works. So we know right now we've gotten expanded ranges in the Euro. So we were down to about 26 pips, one standard deviation moves. We're closer to almost twice that now. So about 50 pips a range. What will be interesting to see here is if we get a non-farm number that is soft. So we're looking for 200. It comes in at 80. Now, the initial reaction will be U.S. interest rates will fall. Bonds will rally, and the U.S. dollar will fall. Now, if the U.S. dollar falls, that means our Euro-USD pair, Euro-USD will rally. The Euro will rally. So if it does, we're at an interesting level here, right at 106. Shorts really haven't been challenged here. If you've been short and riding it down, sure, you didn't cover at the low, but momentum traders wait for really kind of a change. And dip buyers here have been rewarded a little bit, but we really haven't seen shorts being put to the test. If we get an appreciable print up to 106, 106.20 or 30, we will now see a lot of these all these shorts that have been sitting here, and either guys selling little rallies or guys who have shorts, the market's rejected it. 106 rejected, 106 rejected, 106 rejected. Here to be determined. So it'll be interesting to see if we get a spike up to here. And I like to kind of double. I wouldn't double because we've gone from 26 points of daily range to 50 points. My scalping range would probably be closer to 60 or 70. If we get a trade up to 106.70, that's an interesting inflection point for a contrarian, maybe to fade this move. But what we'll be telling is if we trade above 106 and we hold during the day, now the shorts will be put to the test. If we trade up there and selling immediately comes back into the market, that's going to tell me that being long Euro doesn't have a lot of legs to it. And maybe we trade a little bit lower. So, but interesting inflection point. We'll definitely get a reaction off of this one way or another. But I think that 70-point scalping range will be very, very interesting. Sterling, a little bit different story here. We're through that level. We've tested it a little bit, but looks like a very similar chart. Let's go ahead and take a look at, because we're running out of time here, Where do you want to go?
You know, let's check out. I would love to see a little on peso if we could do that. I've been kind of,
Okay.
mentally following it lately.
Very good.
Oh, that's so interesting. Yeah, after the tariffs and the announcements and all of that, I've just been really curious with the automotive industry and the dollar's, strength has been pretty clear, but.
Well, and I think that 20 peso to the dollar level was where we kept fighting with. We got close to pre-election. Once the election hit and the tariff announcement came out, 25% up top, 25% for everybody below, Mexico and Canada, we traded up to almost 21 pesos to the dollar. Now we've rolled all that back now. And we're right back to that 20 peso inflection point. So this could be an interesting one too, to see. It will be interesting because this tends to be a little bit tariff driven. Will we see the same driver take place from non-farm payrolls? I'm not quite sure we'll see as much movement in the peso as we may euro, yen, and sterling, but all the FX markets going into Friday are at interesting points. Some of the zeal, we knew the buy the rumor, sell the fact of peso would kick in somewhere here, and it did. It didn't make it easy because it tried those highs, sold off, came all the way back, and now we're trading lower again. It'll be interesting to see how that shakes out. So do want to take a look at Aussie really quickly, and I think we're going to run out of time here. Aussie sitting right on the same lows there, that 64-cent level. That's cheap Aussie. We'll see how that plays through here. Aussie's still on track for some aggressive rate cutting. If the U.S. number is soft, and that may, or if the U.S. number is strong, that may talk to the U.S. isn't going to cut quite as aggressively, and we may see Aussie soften a little bit from it. So scalping range here, about 50 points right now, 45. I usually add about 1.5 times. So 65 to 70 points, either side of 64 here. Back up to 65 or below 64, down to that 63.30 area. Watch to see if that's an interesting inflection point. So great walkthrough by you. Good context around a big number. We're not here to guess whether or not the economists' estimates are right. What we're looking for is opportunity around movement. Today we'll get it at 7:30.
Yes, we will.
All right. Fantastic job out of you. Guys, thanks for tuning in. We'll see you back here Monday morning. Have a great weekend.